All right, now we are back with Bloomberg's Jonathan Weil talking about Huron Consulting Group, which was formed by a number of guys who came from Arthur Andersen, basically formed in the same month that Arthur Andersen disappeared because of the problems resulting from Enron and WorldCom. Huron is supposed to help people fix the kind of problems that brought down Enron and WorldCom. The same kind of problems, at least in the same area, brought down at least about 69% worth of Huron.
And so what happens? It turns out that Huron can't get its own numbers straight. This is a company that consults with other companies on how to get their books right, how to do corporate investigations, forensic fraud examinations, that type of thing. They helped Fannie Mae a few years ago through its accounting problems. And what do they come out on Friday after the market close? They say that, oops, we screwed up our books. Our profits, right? Our profits are going to be down. We're going to have to, wipe away half our profits for the past 3+ years. And but you should continue coming to us for advice on how to do your accounting.
Wasn't it funny because didn't they in their IPO? I think you wrote about something about they talked about the importance of reputation.
The quote was, "Our ability to maintain and attract new business depends upon our reputation, the professional reputation of our consultants, and the quality of our services. Any factor that diminishes our reputation," it just goes on with this huge risk factor warning that they probably should have paid more attention to.
What is the problem with these guys? I mean, are they just doomed? And if so, I noticed in your story, exactly, they took out the management team, all from Arthur Andersen, and replaced them with a management team all from Arthur Andersen. Maybe they should have thought about a different resume for the guys running the company.
Well, the people that the new chairman in particular they put in is a fellow who led Huron's investigation for Fannie Mae some years ago, and there's no doubt that this guy knows his accounting. But it's so tempting to look back on this and say, we should have seen it coming all along.
Well, Jonathan, what were the missteps?
What happened, this is a company, it's a roll-up, basically. Right. They acquire a whole bunch of businesses Pac-Man style. And there are incentives for the sellers of the company, for guys who sell the companies to Huron have incentives to meet certain benchmarks for performance after their companies get bought. Turns out what the old business owners were doing after they would receive their payments from Huron for selling their businesses, they were distributing some of those proceeds to employees of the companies that got bought to encourage them to stay on with Huron to meet certain benchmarks. And under the accounting rules, that compensation is imputed back to Huron, but they've been going years without reporting it.
Well, and it leads to the best part for all the doom mongers out there, and there are many of them, which is that it's also very highly leveraged.
Oh, their debt to equity is like 95%. And not only that, if you look at their shareholder equity, they don't have any tangible shareholder equity. Their equity consists entirely of goodwill and then some, which of course we know, we've talked about before, you can't sell.
All right, Jonathan, thanks very much. Jonathan Weil, Bloomberg columnist. You can check out his column on our website.
Definitely do that.
At Bloomberg.com.